If you can master the skill of trading and use structured processes, analysis, and predict market moves, you can unlock an extremely scalable income generating machine for yourself. But if you learn the wrong way, you can spend years of your life wasting time and money that you don't need to waste. Okay, I've been trading for 8 years now, and before getting to the point of being able to make $3,000 to $4,000 in a single trading session and doing things like going on 40+ trade win streaks and running a global trading team of thousands of members who are also doing this to change their lives, I did spend years genuinely wasting thousands of my own dollars and years of time that I really didn't need to spend had I have known what I'm going to outline to you in this video. Okay, my goal with this video is to really have it feel like you're sitting here with me and I'm showing you the exact no BS formula to get started with this process and to get started trading the right way. So I'll first show you my simple tech setup, some effective trading basics, then how to actually pick a trading strategy, then how to test your own profitability using these concepts, and then how to actually apply this and get access to capital starting with a small amount of money so that you'll have the right foundation, be able to start small and scale, and hopefully generate that income machine for yourself. All right, so first thing that we're going to talk about is the tech stack to get started. So what are all the softwares that you need to actually start the process of learning to trade? And one thing that I want you to remember throughout this video, and this is hugely important if you're at the beginning of your trading journey or if you just want a reset and to start learning correctly, most people when they hop into this game, the first thing that they're thinking is, first off, how do I add money to this system? And then I have to learn all of these patterns, different indicators, different pieces of analysis, and then they're focused on how to actually start making money. Then they try to apply that to the infrastructure of trading. And that's exactly how I started off my process. I really wish that I started the opposite way, and that's how I'm going to frame your mind in this video today. Whereas what I'm going to show you is the infrastructure of trading and really how simple the concept is so that you can master that. And then what we're going to do is we're going to add these things to the process that we've already mastered. That was one of the biggest breakthroughs in trading, not starting with the confusion and trying to apply it to trading, but starting with trading and then apply things that will actually help you. If you're learning how to paint, you're not going to start with an advanced brush technique on a specific type of painting. You're going to start off with the basics of mixing paint and how to start the painting in general. We don't want to hop into the details. We want to get the core and then add where we need it in order to keep it productive. This is one of the biggest pitfalls that people fall into. So let's get into the tech stack that we're going to need for today's video. And also this is a pretty stripped back version of what I use on a daily basis. So first thing is your charting software, which is TradingView. Link is in the description if you want to start using that. There are free ones and there's also paid subscriptions, but this is how we're going to be doing all of our analysis. Next thing is going to be an exchange, a place to actually place trades in the market. Now, depending on the markets that you're trading, it could be a prop firm, it could be a brokerage, or it could be an exchange. Okay, this place is interchangeable. All these concepts apply regardless of whether you want to trade Forex, stocks, cryptocurrency. Today in this video, the example is going to be on cryptocurrency, but all these things are going to apply to any market. The next thing is going to be Google Sheets. I'm going to be sharing with you some custom templates on Sheets. And the fourth thing is Notion for putting together our trade journal. This is where we're going to be tracking our progress. I'm going to be showing you how to use all of these. And if you want access to them, go in the description, follow me on Instagram and DM me the word tools. And I'll send all these custom tools so you can start to apply it yourself. All right, so let's start to dive into trading basics and how the process of making money in the market actually works. Keep in mind, this is going to start simple and get more advanced as we go through the video. All right, so the way money is made in trading is essentially buying a certain quantity of an asset at a certain price. So in this example, 150 units at $200, then later selling each unit at a higher price so that the profit per unit times the amount of total units equals your total profit. And so the way that these opportunities are found is by using tools and data to find repeatable patterns where we expect the price to move up at that point. So right here, I have a chart of Ethereum pulled up. So we're able to see how the price starts to fluctuate. And the goal would be to be able to do some form of analysis to pick key levels where we know that there's a high probability of the price moving in a specific direction, and then buying in at key levels so that when the price starts to move up, you can then sell it for a profit. In this process, the goal is to put yourself in positions where if you're right, you make substantially more than if you're wrong. This is where beginners and people in general start to make their mistakes. So in this situation, had the price have come down to this level first, we would have lost money on the trade. And if it goes here first, we'll make 3 times what we would lose on the trade. And in order to put yourself in a position where you're getting in at these high probability zones, you're making sure that your rules are all being followed, all your analysis being followed, and you're doing proper risk management. This requires a lot more understanding about your own personal data, trading math, and how to trade in general. And unfortunately, most people do not start with this mindset in trading. And some people don't ever make it to this phase because they fall into this trap that I'm going to show you how to avoid. So what most people will do is say, for example, look at a chart and say, every time that there's a big sell-off, price tends to reverse like crazy. Big sell-off, reverse like crazy. So they'll think, big sell-off here, if I buy in, the price will most likely basically start to reverse. They buy in, price ends up reversing, and at first it can be fairly easy to make money because you're actually taking really big risks but don't really understand the risks that you're exposing yourself to, which is essentially the trading version of beginner's luck. You don't have all of the knowledge of what could go wrong, which makes it easy for you to act when you need to. Once you get to a point of advanced trading, you can also enter the market during these times, and these are the times where there's opportunities, but you have to be taking them because you're confident in your system, not because you don't understand the risk implication. So the next mistake in this mental progression would be to attempt the same thing again, but as the trade plays out, it starts to move in the opposite direction. Now you don't want to sell because you don't want to lose money, so you'll be waiting for the price to continue to come up. So then once the price starts to come back up to your entry, all you want to do is get out of the trade. So then you'll take the trade off the table again, and then further reinforce if you just hold the trade long enough, you don't have to lose any money. Human beings are wired to have adverse reactions to being wrong and losing money, because basically in every other avenue of life, if you are wrong or you lose money, it's a bad thing, which is why 95% of people don't make it in this game, because they fail to understand how you have to treat trading. So in this case, we don't want to be wrong, we don't want to lose money, so we'll hold on until it comes back. Then we're able to close a flat profit and say, okay, well, all we have to do is hold this long enough, and then we don't have to lose any money, until we get to the third mistake. So price dips down, take a position, starts to move in our direction, then all of a sudden starts to reverse and go way away from our original entry. So once again, don't want to lose any money on the trade, and after a certain point, the loss gets so substantial that you're forced to take it off the table. So once again, you buy in after market sells off, trade starts working out, until all of a sudden it moves drastically against your entry, until it gets so bad that you're forced to close the trade and realize a massive loss. And at this point, what people will do is they'll go out and they'll start reading books, trying to acquire all sorts of different knowledge, different trading strategies, different indicators, in order to prevent this situation from ever happening. And this is usually the graveyard for traders, where it just continually gets more frustrating and more confusing because they're failing to rewire their mind to not have an adversity against losing and being wrong, whereas what's really needed is to understand professional trading math and how to properly build a strategy where you've already rewired your mind and you're not afraid of losing, which will actually allow you to succeed. So for example, this is a trade that I took last week. I enter the market here, then I immediately take a loss. The trade continued to move up in this trend. So anyone who just took a loss would normally think, okay, I don't want to do that again. Market's clearly moving up. But because I understood how to position size and what my strategy was, I was able to re-enter the market, get into my trade, and then have this completely start to reverse into my direction, come down and allow me to close out a really nice trade. Whereas most people wouldn't be able to enter the market in there because it would seem too risky or too scary. So let's go back to our previous example here on this trade. So say we were entering here hoping that the price was going to go up. The biggest difference in the first part of understanding truly how to trade is by setting an initial risk limit so that you know exactly how much you're going to be losing if you're wrong, and making sure that we enter our position correctly in order to risk exactly what we expect to on the trade. So for example, if we want to buy in here, hoping to sell there and leaving the trade if it comes here, if we want to risk $50 on this trade, we need to enter with precisely 0.71 Ethereum at this exact spot on the chart in order to keep our risk contained. Let's say, for example, our stop loss was here. You'll see now the quantity that we need to enter is now at 1.17, but regardless, the risk that we're taking on this trade is still $50. So looking at this graphic, the risk that we take on each trade, expecting to have a certain amount of profit, are going to be considered as 1 unit of risk. And the only metric that you should be caring about in the beginning of your trading is something called expectancy. And I'm going to show you how this formula works and how this math works, and then I'm going to show you how to find it for your own trading. And this is really the only metric that you need to pay attention to in order to figure out how to make money in the market. So even if it seems confusing, just bear with me. I promise this is going to make sense. So the expectancy is how much you're expected to make on each trade, regardless of whether that individual trade is a loss or a win. And the way that we do this is by finding our average win rate, or the percent of the times that we're taking a win, multiplying it by the average size of our win. So if we're looking in terms of risk factors, in this situation, this is -1R, and this would be positive 5.35R. And we would take that from the percentage of the time that we lose, multiplied by our average loss, which would be -1R. So a lot of people get emotional about individual losses, but if we really look at it, in this situation, we have 10 total trades. Over here, we have 7 losses and 3 wins. So effectively, you're wrong and losing money 70% of the time. But similar to this situation over here, if you position yourself to be able to make 5.2 risk factors, 2.5, 3.1 over those 3 different trades, the total risk factors that you've made, even though you've lost 7R, you've also made 10.8R, okay, which is 3.8 higher than what you lost over that entire period. And averaged out over all of these wins gives you a 3.6R average per winning trade. So at 30% of the time, if we take this formula up here in this scenario where we're right 30% of the time, our average win is 3.6. We're losing 70% of the time at -1. That's going to give us an expectancy in this situation of 1.78R per trade that we're taking. So if we're trading this in real life and we have loss, 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 a lot of times what people do is they start changing what they're doing, they start freaking out, and they start behaving differently. All we're trying to do is find a pattern in a rule set that we can follow when we're taking trades that is going to give us a positive expectancy. And all we're trying to do is follow that as closely as possible. And the beautiful thing about trading is we can test this out and see if this process is going to make us money before putting any money on the table. All right, and as we're testing this process and as we get deeper into trading, you'll understand that trading is basically a game of statistical probability. Okay, it's not random gambling, even though some parts of trading are. It really comes down to probability. So when we're testing this to see what our expectancy is, we can't and shouldn't rely on a small sample size because of something called the central limit theorem. Okay, and what the central limit theorem explains is based in statistics, what we want to see is a bell curve distribution, which is going to show us our actual average statistical result of a data set. If we were to take, say, 4 or 5 trades in a row, maybe we win all 5 trades in a row, which is not going to give us a realistic expectation of what's going to happen over time. Whereas, so in this example, we have a few outcomes at different points, and our average is coming in over here. As we take that same exact scenario over a larger set of data, the average is going to start ignoring these outliers and give us a number which we can actually expect to be true, which in the case of coin flips, this would put our average expectancy at about 70% to get either heads or tails, whereas as we add more and more flips, this average will get closer and closer to 50%, which we know is true. If you flip a coin, you have 50% chance of getting heads or tails. And this is how we have to look at expectancy. You have to figure out how you're going to perform over at least 30 data points, and as long as you have a positive result off of this formula, now you know if you follow that process, you're going to actually make money in the market. But the question is, what process and what analysis do we do on the charts to be able to put ourselves in these situations? So let's get into picking a strategy, and I'm going to explain to you some ways and some processes I like to find these high probability setups on charts to then be able to start building trade ideas around. So when you're building a strategy, it's best to first ask yourself a few questions. Firstly, what market in general you're trying to trade. There's stocks, forex, futures. What I'm going to share with you applies basically to all of those markets, but in my opinion, it's best to sort of pick something that is going to fit in with your lifestyle. So for example, I trade cryptocurrency because the markets run 24/7. I'm able to leverage positions, which doesn't require a ton of upstart capital. And there's a lot of volatility in the market, which gives me a lot of consistent, predictable opportunities to take trades in the market. The second thing that you want to ask yourself is, how much time do I want to dedicate to doing this? And when do I realistically have the opportunity in my life to sit down and start taking these trades? So for example, there's day trading where you're usually starting in the morning and you're sitting there for several hours throughout the day to try to find these trade setups. This is typically happening on a smaller time frame. So anywhere from a 1 minute to usually a 5-minute candle is considered sort of day trading, where the trades typically play out in a few hours worth of time. There's also something called swing trading, and this is usually done on anywhere from a 30-minute time frame to something like a 4-hour time frame, where you're following similar ways of trading, but now the trades take several days to weeks to fully play out, which is obviously better for someone who's a little bit more busy or looking to get into trading a little bit more part-time. And then the third thing that you want to ask yourself when you're looking to pick a trading strategy is, what intuitively makes the most sense in my mind? Does it make sense for me to find current trends in the market and just look for key areas to get in on that current trend? Or do I want to try to find analysis to pick big areas where we could potentially pick and play those types of moves? Now, obviously you won't know this until you start trying, but it's best to find what resonates with you in your lifestyle and then pick one strategy at a time to focus on and master. And that's what we tell the private side of our trading team too, is to focus on one and get really, really good instead of jumping around strategies. So I'm going to share with you guys the general framework of 2 styles of trading that I like to do. One that is following a trend, and then one that is anticipating reversals. And I have tons of videos diving into these strategies, but I'm going to give you a very quick crash course on these so that you understand it. And then at the end of the video, I'll put a playlist so you can sort of dive into these a little bit deeper. The first strategy is going to be a continuation. So it's going to be a process of following a current trend. So what's needed for this is something called the IT foundation indicator, which basically is going to give you a 20, 50, and a 200-day moving average. Now, think of a moving average as just a plotted line that's taking the average average price over time and just sort of drawing a line underneath it. So the shorter term moving averages that are just taking, say, 20 increments of data are going to be more reactive to temporary price action. And then as we go to the 50, it's a little bit less responsive, and the 200 is the least responsive and give us a confirmation on the general direction of the trend. These are all red. As soon as the 20 is over the 50, over the 200, you'll notice that's oftentimes when you get a large enough shift in the direction of the market to have a continuation. So once we have our moving averages on our chart, basically we're picking an overall trend direction. So in this example, when we have all of these moving averages turning green, market's moving generally up. All I'm doing is using this tool here on TradingView, and I'm finding an area once these are all green where there's a noticeable high before a pullback. This is grossly oversimplified. I'm not going to get into all the details in this video because it would be like 5 hours long. Like I said, you can watch it in the end. All right, so then I'll take this and I'll click from this high to my most recent low point, and then all I'm going to be doing is starting with my account size. If we're buying it expecting the price to go up, we're going to select long here. This first box is going to be our price at this level, which we can see right here. Our stop loss value at this level. Limit 1 is this price. Limit 2 is this price. What this is going to do is automatically tell us how much to buy at which level, which is effectively going to allow the price to come down to this level, move up to our full take profit, move down to our second level. If it comes back up to here, it's also going to get us out for full profit. If it comes here and turns around to here, it's also going to be full profit. And then if it comes down to this level, this is going to be our 1 unit of risk. And this is a strategy that I use to win over 40 trades in a row. You can also see our private team members doing things like 69 trades in a row, multiplying their accounts like crazy because you can take so many of these trades in a row and find tons of them in a single trading session and be able to follow trends as they develop. Okay, this is a strategy where the winning percentage is higher, as well as the negative risk factor also being higher. All right, so in this example, we start our position here, trade plays forward, gets us in. We're out for full profit. So we lock in that risk. Then we can effectively take it off of this here again like that. We're in long. We get out here for another full win. Okay, off of this trend again, in long. Another full win. All right, here we get our second dip buy level filled, which means that if we use this calculator, okay, if price comes up to here, we're going to get out for full profit, which it does. I wouldn't take a trade here because I'm waiting for a new high to be produced, which we don't see. Now we have a new low produced, so we can take it in the opposite direction. Price comes up, we enter, get out for full profit, which is another risk factor. So you can see 1, 2, 3, 4, 5 trades taken over the course of 8 hours can put you up 1 positive risk factor. So say, for example, you're able to hit another 5 trades in a row. That's going to give you an expectancy per trade of 0.27. And if we see how this plays out, say over 100 trades, starting with $500 at this win rate, even with the max loss being hit several times, oftentimes in succession, once again, because you have that positive expectancy, you can grow the account very quickly. So for example, if I look at a Solana long I took here, my first entry was here, second and third entries were down at these levels. Then eventually price reversed around and I was able to collect a really nice profit on this trade. Here's another example. Initial entry right at this point. Price comes down, tags my entry, turns around, and gets me out for a nice profit. So next we can look at a reversal model. We can see the expectancy with a 32% win rate and a 1.8% average risk reward. And our losing rate with our per trade risk gives us a 1.25 expectancy. So in this scenario, instead of trying to find areas to get in on a current uptrend, we're actually finding areas where we could expect price to make a major change in direction and then trying to enter in to capture these large market moves. Once again, without going into crazy detail, the general way I like to find these opportunities is by finding a trend that is generally moving to either the down or up direction. In this situation, down, breaking over a key level, and then producing something called a fair value gap. Now, this is sort of teetering on the advanced level of trading, but what a fair value gap is a series of 1, 2, 3 candles where the first candle produces the high wick and the third candle produces a low wick, and having the second candle pass smoothly through that without having any overlap. And you can see right here we had price break out of this down channel, produce one of these fair value gaps, and then the price headed back into this fair value gap before having a significant move to the upside. So what we like to do once we've confirmed that this is a fair value gap, we'll place our risk outside of the candle that gives you that fair value gap. We'll look to enter the halfway point of this fair value gap and then look to take profit up higher in key levels, which you can see can give really high risk rewards. So in this situation, situation, just getting out of the trade here would give you a 1 to 6 risk reward. And if we're position sizing properly, if you guys want this tool, by the way, which will calculate how many units to enter and will show you your risk and your reward, follow me on Instagram, DM me the word tool, and I'll send it over to you. But we have this Innevitrade position size calculator here, where basically you can go in here, add it on your trading view, click on where you want to enter, where you want to get out for profit, and where you want to put your stop loss. You can set your dollar amount risk. This is going to show you exactly the quantity to get in at to risk exactly what you're looking to risk on the trade. Because essentially what you're doing is taking your entry minus your stop loss price, and then you're dividing that by the total dollar amount you want to risk, which is going to equal how many units you want per trade. You can either do that math out, or you can use the indicator, which when I'm day trading, I want to be quick, so I'll use the indicator. But it's really, really important to keep your risk uniform so that when we're calculating this -1 in our expectancy, we get accurate numbers. All right, so let's look at a real life example here of one of these trades. So once again, I find my fair value gap. I find that the trend was reversed, enter into my position, price starts to reverse down, takes a significant move to the downside, and even risking $500, I'm able to be up well over $2,000 in profit, getting a nice 1 to 4, 1 to 5 risk reward before taking it off for profit. All right, you can see one of our members completing 500K challenge in 3 days, making 40K, having those really, really big running risk reward trades, up 6K on a brand new live 100K account in 2 days. It's always good to see people shouting out the private side of the team and quite literally using the full versions of these strategies that I'm showing to you guys to be able to do insane stuff like this. Okay, DC up 800% on his account since the beginning of last month. Okay, so regardless of approach, what really matters is keeping the risk small, measuring your risk, and making sure that you follow the processes as tightly as possible. But of course, once we have these general ideas, we have to actually test them to figure out what our personal performance is and how to make sure that we continue as traders to be able to hit the strategy that we're using. And the cool part about trading is this is basically the only business where you can have proof of concept, see if your business model works, then put money once you have access to capital, which I'll show you in the next module, once you already know that your process works. And the way that we do this in trading is through a process called backtesting. This is going to allow us to find our personal expectancy on any strategy that we're trading. So I like to recommend to do this in 3 stages. The first stages is going to be just using something called bar replay on TradingView. And we're going to be tracking all of the things that we're doing in real time to be able to see theoretically if we're going to be profitable or not. So if we use this button called bar replay, we can actually rewind the chart to a random part, and then all you have to do is hit shift and then forward on the keyboard, and you're able to move the candles forward 1 candle at a time. Okay, and so what I do when I'm testing strategies, okay, say theoretically I would enter at this point, then I could just mark the area where I would theoretically be getting in and then getting out. Then I know by using my calculator, if I lose, I'm either going to have, in the case of this strategy, -1 risk factor, and if I make a profit, it's going to be plus 0.2 R. Okay, and so once I have an example here, I can open up my trade. I can click on this section here. Once again, I built this out and shared this for free with you guys, so feel free to use it. You can go in and put all of your data in there. You can customize this however you like. Put the system type, select, in this case, short, put your risk percentage, whether it was a win or loss. Say in this situation, if you're risking $100, you have a $20 win. And then you can just go back to your chart and continue to play this forward and keep taking trades as they would come. And this will work with either of the strategies. So once again, if we wanted to enter in here, it's short, we've gotten short here again, and then out for full profit here. So another positive 0.2, we would log that. And referring back to the central limit theorem, once you have done this over a wide variety of days and you have at least 30 trades, you can then go in here, go into the sum and click on average here. That's going to give you your average profit per trade as well as your winning percentage. So if you have another trade and you have a loss, this will go down to 66%. You'll have your average win rate, your average size win. And then as long as you're keeping your risk at -1, you can plug it into this model and see if you have a positive expectancy. The next step of the process, once you go through the repetitions just on bar replay on TradingView and you know your strategy, then you can move over to actually executing paper trade versions of these trades. This is where you're using the demo environment of any of your exchanges to practice actually inputting the orders here. That way you're able to actually get used to inputting orders and you can see how your expectancy is looking in phase 2. If you're trading crypto and you want to practice that, I have this platform linked in the description of the video. And then stage 3 of this process, once you know that your process works, is to start this process using real funds. And this is the reason why I like cryptocurrency trading, because say for example, we wanted to enter here, we had our take profit level here and our stop loss here. Say we wanted to risk even $50 risk, which is a fairly small amount of money. And people think that you need a lot of money to start trading because in order to enter this position, if you're entering at 192.12 and you need 77 units, that means that this trade, even risking $50, is technically going to require $14,700. So if I was inputting this into my exchange at 192 using 77 units, you can see that's the capital requirement. What's cool about crypto trading is if we adjust the leverage even to something like 10x, you can see now the capital requirement's basically been divided by 10 and only costs like $1,400. If we increase that to 20, now it's only costing us $741. And as long as this value, which is called a liquidation value, is nowhere near your stop loss placement, then this can allow you to start using very small conservative amounts of risk and not have to have a ton of capital sitting around in your account. A lot of people think that increasing leverage increases the risk on the trade, but as I just showed you, either scenario we're only risking $50 on the trade, but with the 20x leverage, the position costs us $741, and without it, it costs us almost $15,000. Once again, same risk, and this is the beauty about cryptocurrency trading. All right, and if you understand the trading math, you follow your rules, you test it over time, the whole goal is to start with small numbers, know that the process works, and still be able to make nice profits and keep consistent overall. This is a crazy post from one of our private team members, Mac. He says, keep your head in the strategy, learning as much as possible with small trades. Once again, he started here in 2023, was able to make 94K from focusing on the process and using the concepts that he learned in the education. Keeping the risk contained, letting the winners run is the name of the game and how you win trading. If this helped you, make sure you hit the like button. As promised, if you want to learn more about these individual strategies, you can click on this playlist to watch me trading more of these sessions live. Okay, don't forget to subscribe if you want to know when I post new videos. But until next time, I will see you all in the next one.